There we go. There we go. Hello? You might have to switch on. There we go. Yeah, it makes you like switch on the audio and switch on the
Right
video.
on. Can you hear me?
Yes, sir.
All right, boss. What's going on? How you doing this evening?
I'm good. I'm good. How are you?
Oh, I'm blessed, man. Wonderful day. Busy, but it was great.
Awesome. So, want to kick it off? Um,
Let's do it. I'm excited. Thanks for having me.
yeah, no problem. No problem. So this is the Todd Capital Millionaire podcast. This is episode number 49. My name is Charles Oglesby. I go by the name of Todd Millionaire. I'm the founder and the director of the Todd Capital Investment Club. We have over 200 members. Also the founder of Todd Acquisitions, currently under contract for Properties 2 and Property 3. And we're also looking to build up our venture capital firm, which is funding African-American entrepreneurs, college students, college grads who have great ideas. We want to fund your business opportunity, similar to like Shark Tank, and we want you to pitch your deals, and we'll see what's a good deal, what has promise. So thank you all for tuning in. The purpose of this podcast is to share the stories of successful African-American investors and business owners so that people can see and hear the stories of successful examples and learn that business and investing are the true key to financial success and generational wealth. With us today, we have Mr. John Delia. I'm not sure if I pronounced that right, but he's the owner and manager of over a 15-unit portfolio. He's somebody who's a part of the Black Real Estate School. He's connected to Andre Hatchett. And he recently taught a class called How to Buy a 8-Unit Rental Property, I believe. So I wanted to talk to him about his experience in teaching that class. Wanted to talk to him about how he got to where he is now, and also just his goals and how he plans to kind of level that up in the future if he so desires. So with that, welcome to the show.
Well, thanks very much for having me, Charles. I'm really happy to be on the Todd Millionaire show. I really appreciate, just the opportunity to share and, give value to your audience.
Very cool. Very cool. So can you give us some information about your background?
Sure. So I'm a New Yorker by background, if that's a part of my background. I grew up in New York. From then I moved to Columbus, Ohio. Later in Columbus, Ohio, I've been in Ohio ever since. Went to Ohio State, studied city and regional planning. I come from a real estate family. So my father was a commercial real estate developer and business owner most of my life. So, I really had, the opportunity to get coached and mentored from someone, intimately. Right now I'm 27 years old. I operate a real estate investment company and platform, have a investment portfolio, and, run some consulting on the side.
Cool.
So that's like review.
So I guess I'm going to ask you kind of questions in line. I don't want to skip, but
Sure.
You recently taught that class. What was it like teaching a class as opposed to actually doing the work?
So believe it or not, the class is upcoming. I haven't taught it yet, but I have, and I do. I hold monthly meetup groups in Columbus, Ohio, locally. We do real estate investing coaching. So I host 8-week coaching one-on-one with different students. And, I find myself, and I also recently published a book. So I find myself when I'm writing, when I'm teaching, when I'm coaching, I'm able to kind of look back at my history, my deals, and kind of synthesize what I know, as well as really be able to communicate it to others in a way that's tangible and valuable, but meets them where they are.
Yeah. What I found, because I just finished teaching the class that I taught, which is the class on investing as a group, I found that I knew things, but I didn't really know why I knew them, meaning that like I learned it a long time ago. And so I was operating the principle, and I had to back up and say, okay, well, this is what the definition of this is. And you have to kind of go back to the foundation of what you learned and how you apply it. So that was kind of interesting. I felt like I learned it at a deeper level. Having to teach it, you learn it twice. So that was really cool. So when did you get started in real estate?
So tangibly and truly in a company, I'd say, in 2010 or, late 2009, early 2010. But, like I mentioned, because my father was a developer, he was a builder in New York, I had the opportunity, like from a child, I was on job sites and at the brokerage business or different, offices of his. But, in terms of going out, spending my own money and kind of going into the market alone, I'd say that was, 2010, I think, on tax record.
So when you were younger, what kind of projects did your dad work on?
Building single families, a lot of single family subdivisions. Later on, a brokerage, mortgage business. A lot of single families. Later on, he diversified into multifamily, so large scale multifamily. HUD, which is the Housing Urban Department of America, essentially has different multifamily portfolios that would kind of transition in terms of ownership and notes coming due. So we would go to different auctions and purchase kind of large scale sites. That's one of the reasons I ended up in Columbus. There was a big site, 80 unit here, that I ended up operating and helping manage. But all types of diverse kind of projects, I'd say.
That's cool. That's cool. I think that getting that foundational knowledge, especially from your father, I always tell people that when it's your parents, it's a different level of knowledge. They're unguarded. They're not keeping those company secrets from you. They're not trying to keep you in your role of being an employee. And so you're just open to all that knowledge. And that knowledge is invaluable. Everybody talks about, certain people inherited money. But I always tell people there's those conversations around the dinner table that are worth millions, where you're just casually talking about whatever you're talking about. And that's going to take you to the next level, to the ultimate level. I think that just by hearing where you come from and where you are now, I already know the sky's the limit. I already know you're going to do big things. It's just a matter of, I guess, walking into it. So that's cool.
Yeah. And, I definitely agree with everything you mentioned. I'd like to add that, initially it wasn't as easy recognizing the value that I had at home. I think too often because it's family, it's unconscious. And I think sometimes you don't recognize, my parents believed in stealth wealth and not fully acknowledging it. But I'd say on another end, because, and I'll say, our white counterparts did things differently, kind of when your dad's a doctor, a lawyer, attorney, one of the, an engineer, one of these tangible fields, a dentist that you can kind of lay your hat on, sometimes in terms of believing credibility and getting past job title is difficult in our community. So I think for, a dad who was an entrepreneur, business owner, I think it wasn't until later in life when I recognized kind of the lifestyle and opportunity that was provided, to which I was like, oh my God, how did you afford it? But, it takes time to kind of recognize and be grateful.
Yeah. So let's talk about stealth wealth. A while back, I actually had this conversation on Twitter. I was talking about, you see the people that live the high lifestyle are the people who can hang their hat on their profession. Whereas the entrepreneurs kind of have just as much wealth, if not more, but they're more frugal. Their money's tied into their assets because they're not just hanging on to that high income career where you have 100,000, 200,000 coming in the door as a doctor, a lawyer. So basically my point was like, yeah, you see the people that have like the Gucci this, the Louis that, they can afford it, but they're usually just high income, not necessarily high net worth.
Yes. And in our generation, they're, Henrys. So yeah, high income earners, not yet rich. But what I think by that also is it's people who spend a lot in terms of expenses and in terms of being like consumers and kind of, it's definitely keeping up with the Joneses. I think, I was conditioned early on to spend money on clothes, fashion, shoes, bottles. Every weekend we had to get fresh, get my lineup. And I'll tell you, it was completely unsustainable. And when you're in it, I don't, it's just difficult. So, I think that in terms of stealth wealth, I think for me, initially it was hard to believe my father was so successful because, when your friends are having Porsches and BMWs and, they get what they want when, and he's like, hey, we're going to Kohl's and you're going to, buy this, and that. And every now and then, you get some cash or, you get what you want. But, it was relatively very modest. I have a lot of siblings. So I think, it's just the difference in kind of the lifestyles and the choices you make to provide, the best you can.
Yeah, absolutely. So I guess given the fact that you said that you lived in that life and you saw what your parents are doing, what made you follow in similar footsteps?
So honestly, early in life, I'd say that, Honestly, I woke up one day, I come from this East Coast, what is it called? East Coast. I'm from New York. It's so funny. I'm in the Midwest right now, so I always forget. But I come from Roslyn, in a place on Long Island where, there is extreme wealth. And I think for me, one day, like I mentioned, I woke up and we were this black family living in this fancy neighborhood in a normal house, not subsidized housing. We were one of the only, you get these nicknames in school, XYZ. I mean, you know what it is to grow up the whatever in a privileged community. But I think for me, yeah, waking up, I have 7 siblings, which is crazy. 7, I'm number 5 of 7. And I tell you, my dad made a lot of money to be able to live and afford for us to be comfortable. And I think when you're in it, you don't see it, you don't notice it, because it's just like, hey, you eat fresh every day, you do this, you do that. I think it's a lot of privilege. Mm-hmm. But I think, for me, not to speak it, but when you have to go out and kind of create your own, it was never going to be just handed to me to take on the reins, without responsibility. So I think, when you have to kind of learn how to produce income, value the dollar, recognize, what it means to kind of earn and have discipline. I think, for me, I needed to make a lot of money, and I needed to learn how. And I needed to learn how. I guess that's the easiest way to say it.
So you own 15 units. What does your first deals look like?
My first deal was a duplex. It was a double. It was a foreclosure from the VA. This was back in 2009, and I swear to you, I had just moved from New York in 2009. This was 2010. Long story short, it was $6,900, and it was a double. You can't buy a car in New York, let alone a weekend in the city fun for that price. So, when you come here and you recognize, oh my God, they're giving it away, for the earnest money was the full purchase price that I wrote. And, it was, but I'll tell you, I failed on the deal because I fired my father within like the first week of the project, because, I come to the site one day and, he has Mexicans on my roof, giving me a new roof. But the problem was I didn't get to negotiate the price. I didn't know what, I didn't have any participation, and this was going to be my deal, is my money, and I needed to learn. So I was like, F this, like, you can't come in here and take over. Like, I spun out from the company specifically to do my own thing, and I ended up I didn't fail, but I quit like 30 days later. I had to sell it. I was, I didn't know what I was doing. I was overwhelmed. A lot of failures. Long story short, but I did make money. And I made money in 30 days when I got out. So I just decided, look, 1, I'm not going back, and 2, I'm going to do this again and kind of make up for the things I got wrong. But in the beginning, I think I was very stubborn to once again recognize the value that I had back home.
So do you think that if you would have kept your dad on, that deal would have looked different?
I think my whole life would have looked different. But I think where I'm at today, I'm like, man, I don't even regret one bit of it. I think that the things that I've been able to learn by going off the beaten path and kind of trying to find my own and become my own, man, I mean, it's priceless. And I think, it's good to kind of go back and once again, ask questions and have a sounding board. But there was a period where I was kind of like bucking the system and kind of avoiding it at all costs.
So what did the numbers look like? How much did you spend in rehab, and how much were you able to sell it for?
With the first one, I bought it for $69. Honestly, I spent I want to say, it was like $15,000. I spent no more than $15,000 in addition to the initial $69. So I'll round it up and say, what, $7,000? That's another $8,000. I have a case study on lifelibertyandproperty.com about this deal. But long story short, it was a double. What happened was, to be honest with you, when I was working and running, and not even running, when I was working and managing my dad's portfolio and the family stuff, what's funny was you don't see behind the scenes. And for me, I was unconscious to not recognize the responsibility of moving people into housing. It's one thing to want to make money and have time in real estate, but it's another to affect someone's life. And I was a naive 20-year-old who thought, oh, I'm going to own a rental property and get drunk every now and then on weekends and go to my building and fix it. But long story short, I rented it before it was finished. A contractor had burned me. I didn't know enough about plumbing systems and HVAC and all the basics, to be honest with you. I wasn't familiar with it intimately. I managed people and staff, but, in terms of knowing construction systems, I was a little naive. And I got taken advantage of, which happens when you're new. But ultimately, I was moving a kind of a white woman in. She was her name was Brenda. Oh, my God. She was 50s or 60s. you know. And what's funny is she had two sons who were way older and bigger than me. And I swear I was moving her into a house that was nearly finished but not finished. And I just was like, holy hell, like I can't do this. And, you know, and it was funny, there was a guy across the street. I didn't realize I owned a half a block. It was crazy. I didn't even realize what I had. There's a guy across the street, this Asian guy. I'm going to tell you it all, man. This is the first failure, but I made money. But anyway, the guy across the street, Michael, he was an Asian guy. He ended up owning, I was across the street from a trailer park, which was ridiculous. But, you know, everyone wanted this house, but it was the worst house on the street. I had kind of a leg up because I bought it in cash and quickly. But anyway, it was one of these houses that was abandoned. You know, the guy had died. You know, VA took it back. And I had got it at such, like, I had the lowest price it ever sold. Anyway, you know, I got it to a point where it was at least somewhat livable, but not fully finished. The guy had, I swear, 4 different degrees, took me to the buffet, you know, wined and dined me. Hey, John, you know, I want to help you. I want to teach you. You know, and I was kind of, at that point, kind of avoiding my father, the mentor. So I was like, oh, this guy, Michael, probably wants to help me. Blah, 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 blah. Long story short, I sold it for like $25,000, $24,000. I ended up making like $10,000 on the deal. But what's funny was I didn't know back then about lines of credit. I didn't know about a lot of basics because I was a naive kid who just had some money. So I'll tell you, my first deal was it was a hell of a learning experience.
Mm-hmm. Yeah, I think that's important, man. I think that I hear a lot in there, but I think that the most important thing is that you kept going. A lot of times people want to know everything about everything before they buy their first deal.
Yeah.
Never buy their first deal. And so you bought it and you realize you left some money on the table and you're probably not going to leave that same money on the table.
No.
Yeah.
I said I wasn't going to make that same mistake. So I guess I wasn't scared to come back in, but I just recognized I had made a lot of mistakes. And I think, like, as in life, business, real estate, whatever, I believe in a lot of pattern recognition. And I think you have to recognize the sequence and what's going on. Those who pick it up quickly move forward quickly. Those who take too long stay in the same place. Yeah. So I think in real estate, there's a lot of just fundamental patterns, whether it's in dealing with people, dealing with people, dealing with systems, dealing with houses, dealing with neighborhoods. It's kind of the all similar context once you get a hold of it.
Mm-hmm. So what other properties do you have in your portfolio?
So I'll be honest with you, right now my portfolio is completely shifted from where I was in 2010 to where I am now. Right now we own property in 2 states, Michigan and Ohio.
Nice.
And you know, we have multifamily and single families. Yeah, I mean multifamily, single families, and a commercial building actually.
It's funny because we own one in Michigan, in the process of getting one in Ohio. And we're just kind of bouncing in between those two, like just Michigan and Ohio.
Yeah.
We're in Southern California, but we're just not seeing a lot of value in Southern California.
I'm very bullish on purchasing power and secondary markets, tertiary markets. So, you know, being from New York, you're in California. Yeah. I mean, when you look at the purchasing power and what your dollars can buy you, you know, I'm looking for units in rent roll because, you know, I want to sustain my time and my lifestyle from this, you know, from this business.
Yeah. It's kind of like an arbitrage. You're basically, I always tell people we're arbitraging our higher incomes and going into lower income areas and being the big boss.
Yeah.
But providing housing and quality housing for people at the same time. So let's talk about that 8 unit. And I also kind of want to talk about the other 7 units. You said there's 15 units. I'm curious if those are single families, other multifamilies, if it's just another what have you.
So I got to tell you the truth. So what had happened was but okay, honestly. So when I came on board to help teach with Andre, you know, I had to disclose kind of, hey, what do you have, what do you don't have? So at the time, you know, it was 15 units. You know, so what you're referring to, the 8 unit, was actually, I used to have a 6 unit and 8 unit, all brick buildings, but I ended up selling that portfolio in 2016. I was buying in a neighborhood that I had started buying early in 2012. Anyway, the neighborhood was transitioning, it was gentrifying. Anyway, there was a lot of catalysts. I ended up selling that portfolio. Mm-hmm. Right now, we have what is it? We have a 10 unit multifamily in Ohio, a bunch of singles, a 14 unit in Detroit, in Michigan, commercial building, and another duplex. So I'm up to like 30, I think 30 something, low 30s. But we're kind of diverse between multifamily, singles, and now commercial.
Mm-hmm. So is this all you, or are you still working?
No,
or?
So I'm married. So, I'd say me and my wife.
Yeah.
So
how were you able to get her on board?
Believe it or not, this is the craziest thing ever. But we met due to real estate investments. My financial advisor, I had a financial advisor. My financial advisor introduced her to me because it was kind of like I was running a real estate fund back in the day, and kind of anyone who was qualified, usually was referred to me. Anyway, she had referred, my wife to me because she was looking to not just invest in equities, but invest in real estate. She had already, had a rental property in grad school. Long story short, we had met, and, she was supposed to become an investor on board. The deal fell through. We didn't agree on terms. And I kind of just killed the relationship. I was like, we don't need your money. And I was like, goodbye, But, as men, months later, you're like, oh my God, this was a beautiful woman and smart. And, and oh my God, we talked real estate. So inevitably, I went back and kind of like, hey, can we be friends? Blah, blah, blah. And, we ended up just being buddies. But I'd say that, it's luckily, I think she was already on the path. And luckily I recognized that, we could just be stronger together.
Yeah, that is cool. That is cool. So have you seen benefits from you guys working together as opposed to when you were doing it on your own?
Yeah. I think without a doubt, obviously, yes. I think that, obviously, in relationships on one end, you can have a spouse who does, an industry, and then, the other spouse is completely separate and there's no overlap. I think for us, we both gain passion and we both share a vision, like I said, for kind of creating value, revitalizing neighborhoods, providing housing to family, and making money. But I think together, with her background in terms of, experience, education, and with my background, I think, the impact that we look to do in our company together, is going to be huge. So I think that, to kind of find that counterpart is like priceless.
Yeah. I think that, and I've always said this, I think that marriage is a huge hack. I think that it focuses you. I think that it gets you on the right path. I'm married. I've been married for about 2 years, and I've seen that just like my level of focus now, a large part of the, I guess, rapid growth of my company has happened as a result of the marriage, just because I've been that much more motivated, that much more focused. And so I just think it's amazing to have that focus and that motivation, but then also have somebody that gets it, have somebody who's running along the same race as you. I think that's really cool.
Exactly.
So when you were doing all these deals, how did you get the funds to fund the down payment and the rehab and all that? Were you using hard money? Were you using private financing?
So to be honest, my path has evolved. So like I mentioned, with my first deal, it was cash. It was, it wasn't expensive. You know what I mean? It was sub 25,000. I sold it for 24. Yes, it was sub 24 total all in. This was 2009. So the prices were different. But when I rolled it over with cash to another single family, and I bought that one. It was another cheap, inexpensive $8,000, $9,000 house. I mean, I was on a roll at the time to search the MLS. So I had a real estate license. I could search the MLS. So I was able to, I had my criteria. I was able to search, hundreds of leads and then whittle it down. But I came to a point where I was trying to pull out money, and, I had another property that I got into contract. Long story short, the bank told me that, I needed seasoning and they didn't realize blah, 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 blah. So that set me on a path to private funding and creative finance that would have never happened once again. If, when I got in, I was 20, you know what I mean? I was a kid, didn't have the strong credit, didn't have all the years of tax returns. I had nothing. So, I had cash and I had, hustle. But that led me to money. So I didn't want to lose the deal that I had in contract. And I was under construction, finishing another project. So when I was spending a lot, and I was trying to do another deal. The bank had pulled out and I had to close. Long story short, I would go to all these real estate investment club meetings prior to me getting into business. And I would go religiously. I would read books. I would go to clubs. But I said, you know what? I'm not going to lose my money, and I'm not going back to my dad. So put together just a pitch deck is the easiest way to say it now, prospectus, proposal, whatever. And I swear back then, the investment clubs, they would pitch you like $900, $1,000 program. So at that one, I swear at the end of the hour, the presenter pitched, a huge program. And when he did, I saw the couple people who had a credit card and paid. And at the end, I just walked up to people and said, hey, you just bought this program. Are you looking to get into real estate? If so, I got a deal I can show you right now. And I just hustled. I pitched. And I ended up finding a guy who was interested. Later on, it turns out he was an architect. And, I told you, this guy was freaking Joe Schmo. And it turns out, the guy had cash and he was an architect. And that kind of took me down a new path. And then, I ended up forming an investment company fund where, we raised private funds and private equity. And that took me kind of into the multifamily space. But initially it was all cash, and then snowballing. And then from there, kind of compounding and inspiring and kind of getting others to get on board and participate.
So how long did you run that fund for? And do you still run it?
I've since then shifted, and now I have a new platform. But for that, I was, when is it, 2000, let's say 12 to 15, like 12 to 15. And yeah, I did it for a while. And then, the exit, it was just a shift in life. I had Rochelle, my fiance, my partner at the time. It was just, I was changing paces. At the time, I'll also tell you, when I was running a fund, I was also young. So some of the investors and some of the money I took, I wasn't really I wasn't enjoying the situation. We varied and changed in terms of investment philosophies. So once again, there was a lot you don't know until you go down the path and you learn. So for me, being the key kind of deal maker and developer, I decided it was better to kind of exit and kind of ride the wave out rather than kind of, take others for the ride.
Yeah. So during those 3 years, what did those 3 years look like? Were you guys flipping, buying and holding, collecting rents, renting?
It was a mixture of kind of, so we bought, I'll call them distressed and abandoned multifamily. That's when we bought a commercial building. So we bought a vacant 6-unit, bought a vacant 8-unit, bought some singles. I mean, when I was young, man, my portfolio back then was like 30 units. And we bought it. I mean, the city was just free. We transitioned. We were doing a mixture of kind of wholesaling to kind of my private circle and friends who wanted to get in. Others, we did a lot of just fix and hold. I was big on buy and hold. So most of our holdings we held for years and years, because I was, I believed in kind of this. I believed in the neighborhoods that we were investing in and kind of the growth and where they would go. But by the end, it was just, it was a cash intensive business, and the kind of, for the multifamilies, I mean, once again, they're different beats. There was some mistakes, some positives. But ultimately, we were able to return investment capital and kind of keep going. But, it was a mixture of buy and hold and fix and hold. Wholesaled a couple,
I like it. I like it. You were doing some
when I was young, I flipped. Remember, I sold that deal to Michael. But once you realize how much you lose, you leave on the table. And, for me, I was more, I forgot to mention that, there came a point where I was trying to get bank financing. And they're like, look, you don't have W-2 income. So for me, unless you have a consistent rent roll, which provides consistent income with draws and equity, I mean, when you're flipping, you don't have predictable income. You can't get sustainable financing. So you have to, it's an evolution of thinking and lifestyle. And your business model has to adapt to kind of your growth. So if you recognize that, hey, I'm not going to be able to get financing, I need to start having rental income just to increase my, my balance sheet and my monthly income, you're going to get stuck. You're going to get stuck. You got to kind of get out of being stuck.
So it sounded like what you were saying is that you wish you would have never sold, and you realize the power in holding your assets as opposed to selling them. Is that where you're going with that?
Yeah. And if I'm going to relive back then, I hate to say if I wish or if I should or would have, and I would have gone to my dad and said, hey, look, I'm screwing up big time. Can you help me? What should I do? But I didn't do that. I was a stubborn little jerk. But but now, I'm blessed. So you still can't tell me nothing.
The cool thing is you're super young, man. So
yeah, I mean, it was a blessing. I woke up at a young age. I recognized the beautiful lifestyle, and I had the opportunity to learn. And I said, look, I'm not going back to New York broke. I'm not going to struggle. I'm going back rich. And I had to learn the business.
So what do these next years look like for you?
The next years are we're gonna accumulate more units, and we're building a platform right now to kind of help others participate with us. Mm-hmm. We have a philosophy. I believe in the duty and the stewardship in real estate. It's not just about the finance. You can have impact, and there's kind of this ethical element. So we've built a new platform called Housing Joint Venture, in which others can kind of participate in our deal flow and our deal making. Nothing flipping. Most of it's all holding, actually. And it's, difference between different real estate debt and different kind of, preferred equity and joint venturing arrangements. But ultimately, I I want to get to 1,000 units. Me and my wife have these ambitious, crazy goals. But, 1,000 units in our lifetime is possible. And we're really interested in building a legacy. And I think that, for us, if we can kind of focus and hone in, I think, it takes hyper focus, and you have to keep doubling down and, have confidence in kind of being conscious sometimes, because that's where the opportunities are. But, the next few years are just going to be very focused and focused on kind of building, growing, and getting better.
It's funny because I'm hearing you talk, and it's like, I think the same exact thing. And I got started a little bit late. I'm not sure why. Maybe it was the confidence thing, but effectively what I've done is I've created my own real estate fund.
Yeah, I saw that. That's brilliant. You're brilliant. I saw that. All of your what you're doing, I do have to compliment you.
Thank you. But you said something. You said doubling down, and that's one thing I'm always preaching on is you take that revenue, you take your rental income, and you buy more property, or you take your flip income, and then you buy more property, and then you just snowball it. And then you also said just kind of being a contrarian. And that's something I'm always talking about and the crazy part about it is when you're contrarian, a lot of people who go with the flow are going to call you crazy. They're going to think that you're not right, but that really is because that's just how the game works. It's like when everybody's hating on something, that's when you buy in. When everybody's loving something, that's when you sell.
Exactly.
That's cool, man. So I have some questions from the crowd. What I did is I just shared that I was going to be interviewing you on Twitter, and people kind of chimed in. I'm going to start doing this more often, calling it questions from the crowd.
Sweet.
So I'm just going to fire off these questions. The question is, what is the demographic of tenants that you rent to? Are you dealing with Section 8, non-Section 8, market value? What does that look like for you?
So we're actually, I'd say we're mixed. We have a mixture of Section 8 and market value. Now I'd say in terms of market value, there's like the high end market, and there's the kind of mid grade. We're more kind of workforce housing. Workforce housing. But yeah, I do Section 8 all day. I'll tell you, Section 8 gets stigmatized. And once again, I think that when you look at real estate investment, it's a big stewardship, and it's huge in terms of impact investing. When I'm taking my disposable income and allowing another family to have safe, decent, and affordable housing that they can maintain a lifestyle. So I'd say that, part of the eye-opening experience was recognizing kind of these large, in America, we call them the projects. Okay. Let me stop being funny. And all these American cities are saturated with dense projects that have been mismanaged and not cared about, but they're cash cows, man. So, when the government gives you a guaranteed check every day, if I tell you, hey, what if I could give you, it's a bond, or an annuity. So, but we're both, I do it all.
Yeah, absolutely. Very cool. Very cool. So this one is, how do you find reliable maintenance workers and contractors?
You have to do a couple of things. So on one end, you have to be on the ground. What I mean by that is, crazy enough, I drive around neighborhoods and I look for people doing work, and I'll stop them and I'll talk to them, and I'll ask for a card, and I'll test them out. I still believe in Craigslist. It's very old world, but it still works. Referrals work, but it just depends on where you're at and what level. I'd say that I'm not at a cash heavy level where I can just pay the highest end person to kind of come in and do everything. But, I am a relationship guy who, if I'm willing to give someone a shot, work with them, but it's all about kind of the professionalism and kind of, the quality. But ultimately, I do a little bit of everything to find them, and you just got to take risks sometimes. But you start with small projects, not huge projects.
Mm-hmm. That's good. That's good advice, man. And it's funny because it just seems so obvious, but I like how you said that there's the high-end contractors, and there's the the trial contractors.
Yeah. There's tiers. It just depends on my budget. And I think too often people don't have a budget. I think, even prior to the contractor, you have to look at the scope of the project, and you should be able to evaluate the basic kind of cost in terms of material. Material is material, but you can get one of the real, what is it, RIS, or I think it's real data, something gives you industry standards in terms of the cost of labor in the industry right now. So, you can look in prevailing wages, which is like the unions and the Class A guys, or you can look at the just normal, regular market rate, Better Business Bureau certified guys. And you can evaluate, if it's residential or even a townhouse, whatever, you can evaluate the square footage and what you need. I mean, you can go to Lowe's and create a spreadsheet of, everything you need and write a checklist.
That's cool. So this question is in regard to the 8 unit. And the question is, did you JV that deal or did you just go in on your own?
Did I do what?
Did you joint venture it or have a partnership for that one, or did you?
So when I did it, I bought the deal in cash, and then I brought partners to the table to joint venture it. So usually what I do is we buy the asset, we stabilize the asset, we secure the asset, we get it to a point where it's what I believe is it's ready to show / allowing others to experience. And then from there, it just depends on kind of the structure, in terms of what we're looking for. It depends on the financing situation. Sometimes, so like in one of the multifamilies, there was a loan. But others, it's like, hey, I have an opportunity to buy this asset, in cash. And, now I have to stabilize it. I could wait years, or we could bring others to the table. So in that 8 unit particular, we joint venture.
Nice. So that's a situation where you're effectively wholesaling it to the group then.
Not necessarily. So one, I don't discount my value. So I'm a true developer, I'd say, and a builder. I mean, I think there's sometimes reverse roles, valuing money more than you value the building. Mm-hmm. I don't value money, and I hate to say that. Like, anyone has money, but once again, I think that we go back to our values of stewardship, time, this, that, philosophy. So I think that for us right now, it's like, not even right now. I think in general, I think there's, I mean, we're allowing others to participate at, I'll call it market rates. But inevitably, I can't discount the value. What I'm trying to say is there's levels of participation in real estate. I'd say I'm a wholesaler. I buy assets at the bottom price. But above me, I can flip it to an investor, and an investor can still flip it to a retail person, and a retail person can still flip it to the height of the market, if that makes sense. So for me, I can't discount just because I'm good at what I do and I'm a value investor that I got the cigar butt or whatever that I'm going to recapitalize on. But, in terms of allowing people to participate and get a reasonable, not just a reasonable return, but transparency in terms of whether it's accounting or documentation or just understanding the intricacies. I can't even speak. The intricacies of a deal. Most new investors want to learn, and I find that our investors want to get a better education. So for us, we're allowing them, kind of that front seat rider. We're disclosing a lot. But, they're usually getting, something 8 to 12%, and it depends. I mean, sometimes it's preferred equity. Sometimes it's true. It just depends.
Nice. This is dope. I'm learning a lot, man.
Thank you.
It was cool because I heard you use the term cigar butt. Haven't heard that used in a while.
Man, Buffett was my man before I got into real estate.
That's cool. Man, so I this isn't one of the questions from the crowd, but you use the term that you don't value money. What do you mean by that?
There's people with money, there's people without money. People without money need money. People with money recognize that it's not the money I need. It's good money and there's bad money. And I think that people can be controlled by money. And money can ruin deals, ruin vision, ruin a lot of things. So I think that, our philosophy is I have a very kind of firm vision, and we have a very firm kind of goal, and we're trying to build a legacy. So I think if you're trying to build a legacy, you can't be concerned about short-term money or short-sightedness. I think, you can take on bad money that can force a good deal to become a bad deal. And, do you have time to be in membership buyouts? Do you have time to, figure out how to restructure? Do you have time to just kind of take focus away from the vision and doubling down to kind of deal with money, and what we would consider pennies at that point. So, when I bring people into deals, we're not saying that, hey, their equity is worth 70 and we're worth 30. That doesn't happen ever. It's kind of, hey, we're the leader, we're bringing you on, but ultimately we could fund our own, but we're allowing, once again, others to participate because, you can do more with others than alone.
Nice. So I'm not sure if we covered this because we've kind of discussed a few things across, but the question is, did you have a track record of single family buy and holds before you moved on to large scale multifamily or larger scale, greater than 4-unit multifamily?
I'd say yes. So on one end, remember, I have a loophole where I came to Ohio to manage family holdings in the company. So, I got to kind of take on management and kind of ownership of the 80-unit apartment complex that we owned. We had a scattered site portfolio of 30 plus singles. So, from acquisition, construction, redevelopment. But in terms of being on my own, I mean, I made that mistake with my first building. I bought another one. I stabilized it, got a tenant in it. The second deal, the deal after that kind of froze up with financing. To be honest, it was all about my experience to date. I was able to kind of synthesize and organize my thoughts into a presentation and communicate it. And I was just able to show that, hey, I was using my own money and I put my own money up and I documented everything. I mean, every deal that I did in the beginning, I documented every aspect of it. Nice. I saved all my information. So what I took is I brought a case study in front of people who could make a decision. And, I believe it or not, it was a stranger. And I think that when someone has to make a decision, they have to look at what's in front of them. So, part of it is a risk, but inevitably the multifamily was because we all shared the same vision and we recognized that, hey, we have this opportunity to buy this undervalued asset. When I started, we had a business plan and it was completely outside of the scope of the business plan. I'd never thought we could get to commercial so quickly. But when the opportunity popped up and, the broker knew what I wanted, it was like, hey, John, it's in your neighborhood. Do you want it? I said, hey, Todd, yes. So I think you have to be in alignment with the people that you're participating with. Otherwise, you can't accomplish the big goal.
Absolutely. Absolutely. So how many people do you work with these days?
Oh my God, so many. I mean, in what capacity,
Well, in regards to your actual investors, not like your wholesalers, all that stuff.
I mean, my soft network's not that. It's. I mean,
you can pass on the question if you want.
Yeah, I know. It's such a delicate question.
Yeah, and we'll hold off on that one.
Yeah, sorry about that.
Let's see. This question is in regards to property management. It says, how close is the building to your home? And do you have an on-site manager?
So my furthest building is, let's just call it 4 hours away. I'm actually on my way there tonight because I have a delivery tomorrow. So my furthest, like I said, I'm in Detroit, but I live in Ohio. So my furthest building is 4 hours away. Right now we're on the ground, on the boots, but my closest is 10 minutes, 10, 15 minutes. I mean, Columbus is a small town. It's a big city. I mean, top 15, but it's a small town. I mean, it's drivable. I mean, in most bigger cities, you have a lot of congestion and a lot of traffic. Because we're still a developing market and we're just now seeing the population increase, we don't really have aggressive traffic. And I go against the grain. So when they're coming for rush hour, I'm going against. When they're going with, but, I'd say, 15 minutes local, 4 hours regional. And, for right now, we're not management. The words of Gordon Gekko, management can be the ruiners of companies. They can destroy companies. So, we've had property management. Previously we had property even in Texas, but that was sold. But, we had great out-of-state management. And then we've also had, we recognize that we can save money. We can develop our systems. And after we have a sizable, I'd say 100 plus units, I think then we can look at outsourcing it, but at least we've established the basic fundamentals and the benchmarks. Because if you go in there with no benchmarks, the leadership can tell me whatever they want to, but if I have operating histories and I can look back on my historicals, I mean, you either operate my company correctly or, we put you out.
I like that. You said a lot there that I really like. I like the fact that you realize that it definitely is possible to manage yourself and you're leaving a lot of money on the table by just giving that to somebody else. What I've found is that people really don't care for the property manager. They just want their home. So it's like you think they're going to be calling you every night, harassing you about toilets and termites and all that stuff. So in actuality, like sometimes I have to check my phone to see if it's still on because we self-manage as well. I mean, I think we're going to continue to self-manage, especially with the way technology is these days. Like, you don't really need to hire somebody when you can just put a system in place through these websites like Cozy or Regulations.
Exactly. You know, and to your point about kind of those maintenance calls, inevitably, I mean, on one end, we're renovating all our units to a minimum standard. So I think the penny pinchers who don't want to invest in a unit and think that they can just milk it for nothing and it's super cheap and you're not going to get anywhere because you're going to spend it all in maintenance. But, on another end, it's minor. I mean, you put a new hot water heater in there, it's fine. What goes wrong? A leaky toilet, a leaky faucet? I mean, what can you really break in a house?
Mm-hmm.
Oh my God, it's going to flood. Okay, I have insurance. Yeah, I have to go through the deductible. You might have to get some air blowers. But I think that, once again, for the people who don't want to self-manage but still want to participate, I think that's why there's different opportunities for kind of joint ventures, private, crowdfunding. I mean, there's REITs. There's other ways you can participate and not manage. Or, I think those who do manage gain a certain level of experience and that just experience is priceless. Later on, you don't have to do it forever.
Absolutely.
But at least, hey, I know what it is, and I know if someone's lying to me.
Mm-hmm. It's kind of like you said, you establish those benchmarks by doing. So what property management should look like. So if they're giving you a call every week over some nonsense, you're like, hey man, like what's going on here? Or if you've done the rehab yourself that first time, like what it takes to replace that water heater, replace that toilet, replace that plumbing. So that's something I've heard on the Bigger Pockets podcast. It's something we're realizing now. So that when we cross that bridge and you do hire or outsource that company, you're not being taken advantage of.
The other big thing we'll do, and that it's a simple system in Google Drives. It's a spreadsheet, but we keep a maintenance log of every unit and every task and every vendor. And inevitably, once again, because we're self-managing now, inevitably, whether I sell it, it's going to increase value because I can now tell you to the T which unit, which problem, which this. It might be a little anal, but on another end, I have a log and I can monitor expenses. I can monitor the shifts. I can monitor the changes. You can get really intimate with kind of the problem childs, and kind of if there's a big problem or a small problem. But I mean, that log, it's a game changer.
That's good. That's awesome, man. What advice do you have for people who are looking to take their smaller portfolio to the next level?
I'd say you have to kind of small portfolio to the next level. So that's a different kind of question rather than kind of beginner. Yeah, if you have a small portfolio, I'd say you have to really slow down and hone in on your systems, documenting everything, hone in on your accounting, your systems. I'd say your systems, your software, and then at that point, your network and your financing. But until you have your systems, your software, and all that in place, kind of you're just going to keep spinning your wheels because I think once again, your maintenance is going to get above you. Your reserves. Oh my God, establish a reserve account and keep it. And it's hard at first, but believe it or not, the money is on your balance sheet. Investors get super attractive when they see this number that's sitting there, and you're like, oh my God. But yeah, I think a lot of us small guys, you don't want to keep reserves. You want to nickel and dime on just fixing it correctly and spend the money. You got to take the stewardship, the responsibility seriously. That's the only thing I can say. The moment you take the stewardship, the responsibility seriously, I mean, it should fall in place because you recognize kind of the right decision. It's intuitive.
Awesome. So, what does success look like to you?
It's, oh my God, the kid is Nunu. And Nunu came up to me. It's his nickname, I swear. He moved into my half a double. And this little kid tells his mom, I helped him move. I had a pickup truck and I felt bad. But anyway, he goes, Mom, this place is way better than the place we used to live. And I swear the money is great. I swear being out of the country is great. I swear all that is great. But I'm telling you, man, on one end, it's the changes in the neighborhood that I was crazy 8 years ago. And right now I'm a legend, in Columbus, Ohio, because of my predictions. And it's not rocket science. But I'm telling you, the lives that you affect and the people, it's the kids. Like, these kids have no control over what their parents can afford and over where they live. But if you can't provide affordable quality housing, we have an affordable housing crisis in America. In every state, the rent is too damn high and people are getting cheated. And there's just, somebody got to step up. And I think for us, when we look at that duty and the opportunity that we have, it feels really this kid, this moment, you know what I mean? That's like, his name is James, but Nunu. That kid told me how great it was. And I went to their old house, and I tell you, it wasn't that nice, and it didn't smell that great. But maybe that's what, was in their hand at the time.
Mm-hmm. That's cool, man. So what does wealth mean to you?
It's unshakable. It's 1,000 units. I mean, to be honest with you, I think that some people describe it as the amount of time you can go without having to go back to work or stressing, and I think that, year, 2 years, 10 years. But when I'm, oh my God, this thing is a generational game. When, I saw some statistic, I'm sure you heard of it about, the black people would take us 100 and something years, and white people, whatever, about getting out of kind of the poverty gap or whatever it's called. Anyway, when I'm looking at it is, it's playing the game, man. Chess, not checkers. I mean, wealth means that I already know that. I hate to say it, but my kids, I know what they're going to be. I know how they're going to live. I know what they have to do. I know the businesses that we can do to kind of grow and expand. I know this. I know the humbleness that I have to. There's a lot of just basics that we have to set up. But I mean, this is really quick ad lib. Oh my God, Alibaba, Jack Ma. I watched this video of him, and it was of this thing in Detroit. They're investing heavy there. Anyway, he said that when they founded Alibaba, he sat down with his 25 co-founders, and he said, look, we're building a company that will exist for 100 years. And I think in the States and the America and the black community, we do not even think we don't think far. I mean, some of us do, don't get me wrong, but I'll tell you, Alibaba told himself he was going to build a company around for 100 years. Now in my bio, I say that, look, in 2065, I'm going to look back. That's 48 years from now. And, I'll be 75, but I don't think that we have the foresight to believe that the future will come. We just live it.
Yeah.
And oh my God, for me, I've lived now the time, and I've had the blessing to accumulate and keep and watch it grow. And I'm telling you, time is a snap of a finger. Mm-hmm. And when you say, what wealth is, I mean, it's the men who built America and the focus.
Wow. What's your favorite business book?
I will give you Letters to Shareholders from 1963 or 64 to 2012. That was the best book I've ever read. And I'll tell you that it was because Warren Buffett, I used to want to invest in equities because of where I grew up, but my dad said I'd be better off in real estate. But anyway, when I was studying value investing, Dodd, Graham, all the legends, Buffett was a big guy for me, and I loved him. Anyway, when you study Buffett and you read that book, you're looking at how he took a physical assets business, which was Berkshire, textile and heavy, fixed assets and, heavy machinery that you have to invest in, retool, blah, blah, blah. Think post-industrial. And he took that and took it into a cash flow, life insurance, float heavy, liquid business. So, even for me, in terms of shifting my business model, looking at how we structure investments, et cetera, you really have to evaluate kind of, the kind of investments you're making in businesses and assets and investments, et cetera. So if we're looking at business, I'd say Letters to Shareholders.
That's cool. What's your favorite real estate book?
That's a good question. What's my favorite real estate book? I mean, I should say my book, Plug, Life, Liberty, and Property. I just wrote it. It's the best book I ever... No, I'm kidding. My favorite real estate book, honestly, it's skewed because, once again, I come from a real estate family. So it's called Legacies of America's Master Builders, and it's a story about the Trump family. And believe it or not, I studied city and regional planning, and Fred Trump was a big builder in New York. They made their money off subsidized Section 8 housing. Donald, was like me, he was like, oh my God, I don't want to do that. I want to do luxury. I didn't get to luxury yet, but he wanted to rebel. Anyway, when you read that book and you look at the kind of the conflict of even city planning, there's a famous planner called Jane Jacobs. She wrote this book, The Life and Death of American Cities. Anyway, this, planner, Robert Moses in New York, all the conflict and literally it spills its history. And I'll tell you that you wouldn't have learned it unless you read, you either understood city planning or this or that. But when you look into the Trump family and that Donald decides, look, I don't want to do subsidized, I'm going to go luxury, and then look at him today. And I'm not agreeing with any politics or this or that. I don't want to get political, but I'm just saying, if you look at the brand that was built pre-whatever, he definitely established a luxury presence. And They built, I mean, they were like getting like $50 million a month in rental income in New York of like subs. It was disgusting. I mean, it's a remarkable book. It's my favorite real estate book.
So basically what you're saying is that it's better.
It reminded me of my dad. My dad was a subsidized housing developer. You know, when we went large scale, you know, that 80 unit, I'll tell you, at least 80% of it was Section 8. And you can't just mess up. You have to be very good. You get inspected, this, that. It's a lot of government process. But I'll tell you, it reminded me, once again, I had, you know, Donald White guy, you know, Fred White guy. My dad was a black immigrant developer who got big. I wanted to, at the time, be all bougie and get luxury. But it just reminded me of, like, damn, this is like, your family can do it. You can do it. Like, somebody had to decide.
Very true. Any last words you want to leave with the listeners before we go?
The biggest thing, once again, is just, you know, real estate is it's a forever business. You impact people in the built environment. And what I mean by that is, it's just like, you know, all of us are affected by the buildings, by the, you know, whether it's nice, whether it's bad, your health, your mental health. So I just say, like, even if you're investing, whether it's passive or active, you know, even when we look at it kind of, you know, once again, the equity markets or the financial markets, when there's this kind of incentive to, you know, divest from fossil fuels and divest from bad investments, I'd say it's the same in real estate. You know, do your diligence and just make sure that where you're investing and where your money is going, you recognize kind of the stewardship and the responsibility that those dollars buy. And, you know, don't take it lightly.
Absolutely. So where can people find you?
People can find me on you know, on housingjointventure.com, housingjv.com. You know, I'm on all social media. On Twitter, I'm JS Delia, Delia, my last name. Instagram, I'm just John Delia, you know, plain old me. But you know, my website is housingjv.com. You know, and I'm accessible through the show notes, I'm sure, or you know, wherever Google will allow you to search my name.
This was a great episode, man. I definitely appreciate you coming on. I learned a ton. I'm going to re-listen to this a few times. Definitely going to make sure we have some super duper dense show notes. I appreciate you sharing your story.
Thanks very much for having me.
So yeah, this is episode number 49. Thank you all for tuning in. If you're interested in joining either of our investment clubs, you can contact us at info@capitaltodd.com. That website is capitaltodd.com. Properties 2 and 3 coming up this month. Who knows what's in store for 2018, but it's going to be big. This is Charles Oglesby signing off.